Hi guys, I just wanted to give you a quick real life example of dollar cost averaging. I've had a few questions recently about how people should divide their trades up. So I thought I'd use our recent AXS trade to demonstrate this. This was an entry limit. We gave 3 entry targets, $47.50, $47, $46. And as we said, split entry at these levels. So for numbers' sake, we're going to say we divide the usual allocation, and remember we always risk a small amount of the wallet because obviously nobody can win every time, and we're going to say for numbers' sake we use 10 times leverage. So we're going to use 2 examples, trader A, trader B. Of course, trader A enters all of their allocation at the first entry and doesn't leave any room to dollar cost average, so their average entry is the 47.50. Whereas trader B divides their allocation over the 3 entry points and gets an average entry of 46.83. In this case, the price did fill all 3 entry targets, meaning that the 46.83 was really achievable. Then as the trade develops, this gives an example of the potential profit and loss. So if trader A entered everything, obviously entry 1, if this goes to stop loss, they are going to be 70% down. So if they entered $100, for example, they are going to lose $70. Whereas trader B would be 50% down, so they would only lose $50. Now we can see here, obviously, the differences as we move along. But the real difference is that by entry 2, trader B is actually in a small profit already, even though it's below the initial entry and nowhere near take profit 1. Still in profit, and by entry 1, trader B would be 14% in profit, just by being at the first entry point, whereas trader A is only at break even. And this is actually my personal trade, and again I use 10 times leverage to demonstrate to you. I actually had, as you can see, an entry price average of 46.71. So we can see here that I actually ended up closing a fair amount of the trade before TP1, just after TP1, for 34% profit with 10 times leverage, and it allowed me to move my stop loss to my entry. And even if it drop back to the entry price, I wouldn't lose any more. It would close me out obviously at break even on the rest of the trade. Whereas if it went back to this price, trader A would end up losing money. So as you can see, it's a great way to reduce his risk if it hits stop loss, but it also increases profit potential if the entries all fill. Of course, the downside to this is that if it doesn't fill all the targets and you've only got a third of your allocation in, for example, at entry 1, then and it moves up quite fast, your profit potential is less that way, but your risk is less too. So overall, I always recommend to dollar cost average, especially the way the market is at the moment. We can't just jumping in putting in all your allocation at entry 1. You may as well go to the casino. It kind of you're just massively increasing your risk. So yeah, always try and enter dollar cost average under the initial entry. Hope this video helps you a bit, guys, but as always, if you've got any questions or you're not sure of anything, just let me know.